Hello and welcome to the lecture for accounting, and we will be placing an emphasis on managerial accounting today. The objectives we want to be able to accomplish today are to be able to explain the fundamental accounting principles that connect financial and managerial accounting, differentiate the purposes and roles of financial and managerial accounting, describe the three main activities of managerial accountants, explain how profits change by adjusting selling price, sales volume, and costs. Evaluate what determines profitability in products, services, and customers. List the factors that guide a wise financial decision versus another, and explain the consequential impact. There are a few basic accounting principles that should be explained before diving into the material. The most basic accounting concept is the accounting equation, which is that assets equals liabilities plus equity. This concept is paramount to the four financial statements. The first is the income statement, which takes the gross income of a company and calculates the net income. Second, the retained earnings statement determines the revenue retained in a company. Third, the balance sheet is a detailed breakdown of the basic accounting equation. It determines the company's assets, meaning the total company assets, liabilities, meaning the creditor-provided assets, and the equity, meaning the assets provided by the shareholders and retained earnings. Lastly, the statement of cash flows determines how much liquid cash came in and went out. Dual roles of financial and managerial accountants include recording, estimating, organizing, and summarizing financial and operational data using the financial statements. However, there are a number of key differences between financial and managerial accountants. Financial accountants reports to those outside a company, meaning owners, creditors, tax authorities, and regulators, whereas managerial accountants report to managers within an organization for planning, controlling, and decision-making. Financial accountants focus on past financial activities, but managerial accountants focus on future financial decisions. Financial accountants emphasize objectivity, verifiability, precision, and company-wide reports. In contrast, management accountants emphasize relevance, timeliness, and segment reports. In this lecture, we will be focusing more on managerial accounting. There are three main activities of managerial accountants: planning, controlling, and decision-making. Planning involves setting a goal, forming a plan to execute that goal, and creating a budget consistent with a specific goal. Controlling is about gathering, evaluating, and responding to feedback, utilizing detailed performance reports to understand and implement excellent performance and necessary improvements. Decision-making is focused on making decisions that answer what to sell, who to serve, and how to execute. One tool that can be used to evaluate product profitability is cost volume profit analysis, or CVP analysis. Here are a few key terms that are supplemental to an understanding of CVP analysis. Contribution margin is revenue minus variable expenses. Break-even point is the point where revenue and expenses equal zero. Margin of safety is the total budgeted revenue minus the break-even point. Cost structure is the relative proportion between fixed and variable costs. A sales mix is defined by relative proportions in which a company's products are sold. CVP analysis is useful for different reasons. It can help with identifying what products and services to offer, what prices to change, what marketing strategy to use, and what cost structure to maintain. There are 5 factors that affect a CVP analysis, including selling prices, sales volume, total fixed cost, unit variable costs, and mix of products sold. This is an ideal model of how fixed costs and variable costs are correlated to profitability and the break-even point. The red section represents net loss, and the blue represents net profit. The angle of the line that represents profit increases as the sales price increases, thus lowering the break-even point. In the case of vice versa, the break-even point increases as the sales price drops. Variable expenses are calculated by a cost per unit basis. Therefore, if you increase the variable expenses, the slope of the variable expense line will increase, which will consequently increase the break-even point. The opposite input will occur with the opposite input. The same rule applies to fixed expenses, only the slopes of the sales and the variable expenses would remain unchanged. This represents the CVP analysis of one product. But what about two products? In order to find the break-even point for a sales mix scenario, the break-even point for both individual products need to be calculated so that you can know how many products need to be sold. Then you can create a linear function connecting the two break-even points. This will help create an accurate visual picture of how sales volume combinations with multiple product lines can affect profitability. Now we will look into activity-based costing, or ABC, which is another tool used by accountants to calculate costs of job activities. Before we get into this, there are a few necessary key terms to understand regarding how different costs are defined. Direct costs are those that are easily traceable back to a product. Indirect costs are those that are not easily traced back to a product. Manufacturing costs are costs that are easily traced back to operational costs. There are a few different types of manufacturing costs. Direct materials are raw material that are a part of the finished product. For example, cotton would be considered a direct material in manufacturing socks. Direct labor is the labor that is easily traced back to a product. In our sock example, this could be the manufacturing labor making the socks. Overhead refers to all other manufacturing costs other than direct materials and labor. There are namely two types of overhead expenses. Indirect materials refer to anything used to create the product that are not a part of the finished product. In making socks, this could mean a sewing machine. Indirect labor is also not easily traced back to a product. This might mean the receptionist's salary. These are all the manufacturing expenses. Of course, we also have non-manufacturing costs, which are the selling and administrative expenses of a company. In terms of ABC, an activity is an event that causes consumption of resources. An activity pool is a list of activities that accumulates costs. An activity measure is defined as a scale of what drives the cost of an activity. ABC is a costing method that is mainly used to help managers analyze cost information by tracing activities back to a product's variable costs. This assists managers in making strategic decisions that affect output capacity, fixed costs, and variable costs. There are 5 different types of activities that are recognized or categorized in ABC. First, unit level activities are those that are performed in proportion to unit production. Batch level activities are performed each time a product batch is processed or handled regardless of the number of products or units in the batch. Product level activities are product-specific activities that must be executed regardless of the number of products produced or sold. Customer level activities include customer-specific activities. Organization sustaining activities are activities performed that are unconditional upon which customers are served, which products are produced, how many batches are on run, or how many units are made. In ABC, there is a 5-step process that is followed. First, we need to define the relevant activities, activity cost pools, and activity cost measures. Each activity is put into the form of a percentage of the total overhead cost. Then we need to assign overhead costs to activity cost pools. This is calculated by the first stage allocation. Third, we need to calculate the activity rates, which determines how much of the relative rate of a certain activity affects the total cost. Then, we assign the overhead costs to cost objects. This is calculated by second stage allocation. Finally, we prepare the management reports. This figure represents a simple outline of how ABC is implemented. We start by determining our cost pools and activity measures. Then we use first stage allocation to assign overhead costs to the activity cost pools. Then we can use the cost pools now in dollar figure to determine the activity rates by converting them into an activity measure format. Then we need to take those overhead costs in step 2 and apply the second stage allocation, converting them into cost objects. Examples of this can be product lines or customers. Then we can prepare the management reports to analyze the data and make decisions on whether to continue or discontinue a product. The last concept of accounting that we will cover is differential analysis. Differential analysis is a method that compares two or more alternatives and using the projected income statement of each scenario to determine the best decision to make. This is a tool that is heavily focused on decision making. There are 6 concepts to consider in differential analysis. First, we need to consider our options or what our possible alternatives are. Second, we need to consider the relevance, meaning only focusing on the costs and the benefits that are relevant to the different potential alternatives. Third, we should list the pros and cons to analyze the future cost and benefit differentials among the alternatives. Fourth, we need to discard sunk costs in the past, which are costs that have already been incurred but cannot be taken back. Fifth, we need to consider the material value of each relevant cost and benefit differentials in order to avoid including alternatives that don't really make a notable difference in profit. Lastly, we need to identify opportunity costs in order to identify what we sacrifice to get a separate reward. It is important to consider this to decide as a company what is worth missing out on. Upon applying these key concepts, this is a great model of a differential analysis. We can see that although there was a revenue drop in the second alternative, the expense drop is actually more significant. This results in a higher profit for the company. One helpful tip to consider is to compare the revenue drop and the expense drop. This will be helpful for managers to consider various costs and benefits among the various alternatives. So that's it for our accounting discussion today. So before you move on to the buying and selling life cycle discussion, make sure to check out the technical communication and the business law lectures. Thank you very much.